When we talk about numbers, when we talk about figures, so quantitative data, we see a range of responses from great joy because some of us really love working with numbers, working with figures and seeing what they mean. For others, it invokes a reaction of complete dread. I was one a few years ago now where when I began to look at businesses and how they worked, it took me a while to work out what it all meant, how it fitted together. And then I had a light bulb moment. So my promise to each of you is my light bulb moment. If it came to me, it will come to all of you. Let me explain a little bit about what I mean. So when we look at a business, there are many different financial statements that we need to understand, that we need to bring to life, because we can. A balance sheet, a profit and loss account, and a cash flow account are three of the main financial statements. A balance sheet is where we look on the one side at what we call fixed assets and current assets, and then we look at liabilities, long-term liabilities, and current liabilities. So we add the fixed assets and the current assets together, we add the long-term liabilities and the current liabilities together. Guess what? They balance. Then, if we look at current assets means cash or near to cash, what we call cash or near to cash, coming into a business, and then we compare that with cash or near to cash going out of a business, so that's your current liabilities. That then tells us, if we just take a step back and think, well, actually, if you've got cash or near to cash coming in, cash or near to cash going out, then over a period of time, what comes in has got to be greater than what goes out. So it's actually quite logical, it's quite straightforward if you look at it in that way. And further, with a balance sheet, you can draw a really close comparison to yours and my household. Because we look at our household, we look at our homes, fixed asset is where we live. So maybe purchased by way of a mortgage or maybe by a long-term commitment to rent, probably one of those two options. And then all of us have cash or near to cash that comes in, so how we get paid and other forms of income that come in, and we have, do we ever, cash or near to cash that goes out, so how we spend what we earn. And we know that over time, what we have coming in has got to be at least equal to, preferably greater than, what goes out. Otherwise, you get to a situation that is non-sustainable of debt. And it's exactly the same when we look at current assets, current liabilities of a business. The analogy is exactly the same. And then when we look at a profit and loss account, what a profit and loss account does when you're looking at a business, it looks at sales, so income, take away all of the expenditure, so your overheads, and what you've got left is what you call your gross profit. You take away tax and you're left with your net profit. And why that's important to a business is that they're looking at what they're selling, so what their customers are buying. They take away the costs of production, if you like, your expenses, your overheads, and that's what you've got left. And then the only other outgoing, if it's appropriate, is to pay the HMRC, so tax, and then what's left is your net profit. Cash flow, then, the third of the three financial statements we look at today, is where a business, and actually a household as well, tracks cash that comes in as against cash that goes out. So clearly, again, over time, what comes in has got to be equal to or greater than what goes out. Otherwise, you're going to have a non-sustainable deficit situation. Something has to give. And there's some really good news about these financial statements. Once you've worked out where all the figures go, so for example, in a balance sheet where your current assets go, on one side of the balance sheet, and they usually consist of cash, of stock and debtors. Once you've worked out, for example, where those figures go, and then on the other side of the balance sheet, the current liabilities, where you're looking at creditors, short-term loans, perhaps overdraft, for example. Once you've worked out where they go, and then on the profit and loss account, where you put your sales figures and where you put all your expenses figures, once you've worked that out, you've got it. Because a profit and loss account is a profit and loss account. They're constructed in broadly the same ways. The figures go in the same place. When you build a balance sheet, the figures go in the same place. And I promise you a really tremendous feeling the first time you build a balance sheet and it balances. I remember my moment when that happened. It was in an exam and my balance sheet balanced for the first time ever. So I knew I'd passed. And with your cash flow account, you just track cash coming in, cash coming out. That's probably the most easiest of those three financial statements that we're looking at today. So my promise to all of you, going back to where we began, is it's great fun looking at these figures once you have your light bulb moment. Because what it means you can do is you can look at a business, you can look at these financial metrics, and you can bring that business to life. You can really understand what all these different figures mean in terms of what that business is doing, how well it's performing, how well it's going to be performing in the longer term, what challenges it might face, what figures it needs to increase or reduce. It just brings the business to life. And if you share my passion for doing such things, I've had best part of 30 years now being able to look at businesses and really getting an understanding of how they're working, how I can work with them, how I can offer some perhaps advice and opinions and how that business comes to life. It's a really good place to be. So I hope that you share my excitement and I hope that you share my journey to your light bulb moment as well. Thank you.